Hallo iedereen, mijn naam is Johnny Verkuringen, CEO bij Europese Goudstandaard, een Belgische dealer in fysiek goud en zilver, baren en munten. Vandaag hebben we opnieuw een hele speciale gast bij ons. De gast die we vandaag hebben is wereldwijd bekend in de financiële sector. Hij heeft dan ook een uitzonderlijke lange staat van dienst van meer dan 35 jaar en is actief geweest in de 7 grote financiële centra van de wereld. Van Londen tot Sydney, van Tokio tot Hongkong, van Singapore tot New York. Momenteel is hij actief voor Matterhorn Asset Management in Zwitserland als senior advisor en voor Vulpes Investment in Singapore als portefeuille- en strategieadviseur. Sinds 2014 leidt hij ook de Real Vision Interview serie, waar hij de programma's leidde in Conversation with en On the Road, waarbij hij voor zijn kijkers buitengewone investeerders interviewde van over heel de wereld om hun geheimen en successen te ontdekken en te leren kennen. De laatste 10 jaar is Grant uitgegroeid tot een van de meest populaire en gewilde sprekers in de financiële wereld. De onderwerpen die hij behandelt zijn zeer uiteenlopend, variërend van macro-gerelateerde kwesties zoals het beleid van de centrale banken, tot individuele activa-klasses, landspecifieke cases en beleggingsthema's en allerlei andere strategieën. Verder beheert hij een van de meest gelezen financiële nieuwsbrieven ter wereld. Zijn presentaties en voorstellingen worden door meer dan 500.000 mensen per keer bekeken. Door zijn huidige professionele loopbaan reist hij veel en hij is veel onderweg uiteraard en moeilijk bereikbaar. We zijn dan ook bijzonder blij en dankbaar dat we opnieuw een gast mogen ontvangen die gezien wordt als de top 5 in de sector wereldwijd. Maar we gaan hem zelf hiervoor aan het woord laten. Welcome Mr. Grant Williams. Can you tell us a little bit who you are, what you have done in the past, and where your attention is currently going most in the financial markets?
Sure. Well, it's great to be here. Thanks for having me, Johnny. I have a broad background over a 35, nearly 40-year career now. It makes me feel old. I began in the Japanese bond market back in the mid-1980s, and then ended up in the Japanese equity markets. From there, I moved to Southeast Asian bonds, convertibles, spent some time in Tokyo, spent some time in New York, Singapore, Sydney, Hong Kong, London, all over the place. And I'm now currently in the Cayman Islands after co-founding a company called Real Vision back in 2014, which is an online financial interview platform. I left there in 2019. And have just kind of refocused my attention and my energies on my newsletter, Things That Make You Go, which I've been writing for over a decade now. And I've added a podcast to that. And I guess, look, I've spent an awful lot of time traveling around the world talking to people about finance over the last 10 years or so. And it's been a fascinating journey for me. I've learned way more than I've taught, that's for sure. And it's been a huge privilege to get real time to spend with some of the best thinkers in the industry. And so, that's helped me refine my own investing framework. It's helped me understand the world better. And, over the last 6 months or so, there's one conversation that no matter what you begin talking about, always seems to be where you end up. And that is inflation. Are we about to see the return of inflation after, really 40 years without it? Or is this another scare and we still remain kind of mired in a deflationary world? And so that's where most of my thinking has been going over particularly the last sort of 3 or 4 months, I guess, because it seems like such an important topic to understand, to get right, because
it is.
After 40 years of deflation, there are very few portfolios in the world that are set up and constructed to handle an inflationary world. So if we do actually have inflation as our main threat, then there are going to have to be an awful lot of adjustments made to just about every portfolio on earth. So I think that is the number one question that investors have to think about today. There's no clear answer yet. I have a view on that. Perhaps we can talk about that, and other people far smarter than me have a different view. So it's really something that I think you have to continually pay attention to from here on.
Okay, welcome, and we are very glad to have you. Maybe we can go to our first question. So you have been on the trading side for the investment banks and in different parts of the world for a long time, managing, as I understand, billions of dollars. Over such a long period, you will undoubtedly have experienced nice periods, but you will also experience a number of bubbles and crashes up close. Can you tell us about the bubbles and crashes you have experienced?
Yeah, for sure. I mean, I consider myself very fortunate in that in my very early days in the industry, when I was a very junior trader, I ran smack bang into the '87 Black Monday crash. And that's been, I take that as a wholly helpful exercise for me, because it really taught me at a very early point in my career that markets can fall 22% in a single day, you know, and I think once you realize that's a possibility, it kind of grounds you, and it helps you understand that no matter how frothy things get, no matter how big a bubble might get, there is always this chance that we can see significant damage to a portfolio, to a trading book, whatever it may be. And so I think that's kind of helped me be aware of that and helped me focus on risk throughout my career. You know, I then kind of traded my way through the Japanese twin equity and real estate bubbles, both from London and then up close in Tokyo. In fact, I was in Tokyo when that bubble finally reached its peak at the end of 1989. So I saw what the final part of a bubble looks like, and I saw what the aftermath looked like, and again, that was very, very helpful for me to recognize future bubbles. Even though, you know, as a young trader in Japan, I certainly don't feel like I recognized the equity bubble as quickly as I would do now if I saw a similar thing happening. And, you know, experience teaches you that. There's really no substitute for it. Then I found myself in New York through the dot-com, the kind of last throes of the dot-com bubble. I was in New York from the mid-1990s to the early 2000s. So I saw that up close. And again, having had my experience in Japan, I managed to realize what was going on in dot-com stocks much sooner. That really helped me. Obviously, the bust was pretty terrible, but I managed to kind of sidestep that, which is great. And then, of course, 2008. You know, at that point, I was down in Australia. I'd moved to Australia in 2005, and when I first got down there, I was talking to people about this thing called subprime, you know, subprime mortgages, and you know, this was just starting to come on the radar of some people, and I was again fortunate to have spent some time talking to people that really followed this stuff closely, so I had a good understanding of what was going on. And of course, down in Australia, nobody cared. And, you know, at the time, quite rightly, not only did they not care, they didn't feel like it was a problem that was going to affect them. And of course, as time went by and Australia got caught up in the global financial crisis, just like everybody else did, you know, suddenly there were a lot of guys in Sydney coming to me saying, look, explain how this works. What the hell's going on? You know, it kind of came out of the blue. So I think the important thing, Johnny, is no matter what you find yourself going through in your career, and none of us get to choose that, you know, we're products of the times in which we kind of have our working lives. It's just so important to pay attention, you know, pay attention to what's going on around you, and make sure that you're kind of in the moment, and you appreciate what's happening in and around you in a short period of time, on a daily, weekly, monthly basis. You know, it's very easy to get swept up in things. And, you know, back in those previous bubbles, we didn't have the internet. So information, particularly in the 80s, in the 90s, and even the dot-com crash, you know, the internet was so nascent at that point. We didn't have access to information like we did today. So really, there's no excuse now, even in the midst of a bubble like we're in now, and I believe we're in the biggest bubble of them all right now. You have the ability to you know, read the thoughts of people who believe it's a bubble, and you have the ability quite easily to read the thoughts of people who think it's going to go on for longer. And it's equally important to read and listen and understand both viewpoints, and then make your own decisions about this. So, you know, that's the one lesson I would say from bubbles and crashes, is just pay attention and make sure that you learn your lessons quickly, and that will help you, because there will be another bubble, there will be another crash at some point in your career, that's for sure.
Now, with the experience you have from the future, from the past, in the period we are in now, you also think we are in the biggest bubble then?
Yeah, I do. I think this is a bubble of epic proportions, and it's fundamentally driven by abundant liquidity as well as easy monetary policy, and it's now gotten out of control. You know, what we're seeing now is I think the beginning of the end of this, because we've reached a point where there is so much leverage in the system now, so much of the entire financial system is completely dependent upon zero cost of credit and abundant credit. You know, we've got hundreds of zombie companies in the S&P 500 that can't pay their obligations out of cash flows and need to be able to roll their debt over just to stay in existence. So we've kind of reached a point where rates can't necessarily go up, because if they do, that will create all kinds of negative effects right through the capital structure, right through financial markets. And yet, going back to that first point I made about inflation, if we have got an inflationary problem facing us, then rates are going to have to go up to try and contain that. So you have to choose, much higher inflation, which we all know is a very dangerous thing to allow, or we have to choose higher rates to keep it in control, and that will blow up an awful lot of levered bets in asset markets right around the world. So, you know, again, understanding the problems. It's fine to stay invested in markets. It's fine to stay long the equity market, long the bond market, as long as you understand
what the risk
the potential danger. When this thing turns, it's not just going to be another buy the dip moment. We are facing a proper drawdown, a 2008 or worse style event, and you need to understand that, I think.
We are currently in a period when trees seems to grow into the sky, money seems to be free, and billions of fresh money are being pumped into the system every day. Interest rates stay around zero, and the debt continues to accumulate worldwide, and in many cases can never be paid back. So more and more people are saying that this is the end game, and that we are moving to a new period or reset or whatever name it is. What is your idea about that?
Yeah, I think we are. I think, and it's important for people to understand that these resets happen periodically throughout history. You know, financial systems tend to succumb to human nature, and you know, if you offer people zero cost of capital and all the money they can borrow, they will take advantage of it. People will overborrow, because why wouldn't they? And eventually these situations tend to create problems that can only be really resolved by a reset of the financial system. The last one of those we saw, of course, being after World War II with the Bretton Woods Agreement. That was a reset, and it happened in 1945. We haven't had one of those since then. The financial system this financial system is give or take 70 years old, 75 years old. And so it's long in the tooth, and it's probably due for a reset. Now, what that reset looks like, we don't know. What triggers that reset, ultimately, we also don't know. But normally, it is the triggers for these things are either wars or debt-driven collapses. One of the two is kind of the prime suspect. And if you look very carefully, you'll see that the amount of debt, the amount of leverage in the system, and the fragility that creates, really makes it clear that we could very easily have a debt problem if rates are forced to go up. And on the other side of that ledger, if you look around you at the world, you'll see that realistically, the drumbeat of war is, if not loud, much louder than it has been through the 90s and the 2000s. You know, suddenly, from a very peaceful world, we are enmeshed in conflict wherever we are. If you're in Europe, you have the Russians on your door, and all the media coverage about how terrible the Russians are. The US and China are butting heads. Japan is kind of rattling sabers with the Chinese, the Koreans. So there are a lot more potential flashpoints around the world, to say nothing of the kind of Middle East conflict, which is ongoing, and other parts of maybe the Caucasus, the Balkans. So there are plenty of places where we could see conflict, and so that brings you to the point where you potentially get one of these resets. Now, as I said, I don't know what that reset looks like. I don't know what will trigger it, but I suspect strongly that when it happens, then necessarily I think gold will have to play a part in that reset, even if it's only in the short term to stabilize the monetary system. You know, when you need stability, you need an anchor, you need something that the financial system can be built and anchored around, and really gold provides that. So I expect at some point gold to be brought back into the monetary system, even if it may only be as a temporary measure to try and stabilize and refloat another system.
Yeah, and create trust.
Yeah.
Now, there are different opinions on what we are going to get first. Deflation or inflation, but our viewers are mostly long-term investors. So I think if you look at 5 or 10 years, you can invest with inflation in mind, right? Or not?
Yes, I completely agree. Yeah, yeah. I think if you have the luxury of a long-term investment timeline, it's arguably the single best advantage you can have. If you're able to withstand being wrong in the short term because you have a 10, 15, 25 year time horizon, it's extremely helpful, particularly given the volatility that we are experiencing almost on a daily basis today. And I think if you're trying to trade right now, then I think we have deflation and inflation in that order, and we maybe get another deflationary pulse go through the system. It's quite possible, and say people far smarter than me will make a very, very credible case for that to be the main problem. But I think if you do have a longer term time horizon, then it's pretty clear to me that inflation is ultimately going to be the big problem you have to face. And if you have a portfolio that's performed well over the last 10, 20 years, then it's likely to be heavily weighted towards bonds. You're likely to have a significant exposure to equities and very little exposure to commodities. If we are going into an inflationary part of the cycle, then you will absolutely not want to hold bonds of any kind of meaningful duration. You will absolutely want exposure to commodities, and equities maybe nominally, but at the valuation levels that equities are at right now, and the damage that inflation would do to the businesses of those companies, arguably an exposure to equities is fraught with risk unless you carefully pick and choose the companies you want to be exposed to. So I think it's time, after a couple of decades where passive investing has been the way to go for people, and it's been okay to just put your money into the market. I think along with the rotation perhaps from deflation to inflation, you're going to see a necessary rotation from passive back to active. And likewise, and we're already seeing this quite clearly, you're going to see a rotation from growth to value. And all those things go hand in hand. So you can see there's some big changes that potentially people have to make to their portfolios. And the good news is you have the time and the ability to do that right now, because even though we're starting to see those rotations, particularly the growth to value rotations, it's still early. And so you can still get into some value stocks without paying enormous valuations and high premiums for them, which is a great advantage.
Okay. Now, whatever happens, we will have to get through a period of time from the old current system, the current system, to a new future system, whatever that may be. And as you know, we are precious metal distributors, and we believe that physical gold and silver is the surest and safest way to get through this. What is your opinion on that?
Yeah, look, I've been an advocate of holding precious metals for some considerable time now. I bought my first gold and silver back in 2000, 2001, right around the turn of the century. And despite all the noise, had you put your portfolio 100% in gold in 2000, you would have outperformed the S&P 500, and very few people realize that.
Very few.
Yeah, if you do, but what's more importantly, you wouldn't have had any sleepless nights through 2000, through 2008, and the European bond crisis and all the kind of mini crises we've had since 2008. The volatility really wouldn't have been a problem for you. You've had one period between 2011 and 2015, really, where we saw steady drawdown in the value of gold. but it would have done what it was supposed to do, which is either protect or enhance your purchasing power. And that's so important for people to understand. You know, there is gold investing and there's gold trading. And gold trading, it doesn't really matter that it's gold. You're just trying to buy something low and sell it higher, or sell it higher and buy it back lower. That's really just a trading vehicle. And to me, it makes no sense really to do that in gold, unless you just you trade purely off charts and momentum, in which case gold is great because it moves around in both directions. It gives you plenty of entry and exit points. But as an investor, I think that's where gold really kind of does what it's supposed to do in protecting that purchasing power. And I've spoken about this a lot. You know, people talk about 2008, and this was the perfect example. You know, the gold price, if you remember back in September when Lehman failed, the gold price fell. Mm-hmm. And a lot of people saying, well, this is the perfect time. Why isn't the gold price going up? This is crazy. It just proves that gold doesn't work. But you know, if you look at the gold price did fall, absolutely, because people needed to raise liquidity, and gold gives them the ability to do that. But if you look at the units of S&P that you could have bought before Lehman failed versus with 1 ounce of gold, and you look, even though the gold price fell, the S&P fell 60-odd%, you could buy 3 times the units of the S&P with the same gold, even though the price had fallen. Mm-hmm. So understanding that, understanding the way gold protects or enhances your purchasing power, to me, is perhaps the most important, and in many cases, the most fundamentally misunderstood aspect of why you have gold in a portfolio.
Yeah. I understand, and I hear that you own gold yourself. And I saw in another interview that you look at it in a different way than many other people. Can you tell us a bit more about that?
Yeah, I mean, I think I've just preempted that a little bit with my last answer. But I spend very little time talking about the gold price. You know, I distinguish between the gold price and the price of gold. I think the gold price is a number on a screen. Mm-hmm. It's a number that's thrown around the world every day as a means to value gold, but it's based on the futures market in the COMEX in the United States. Mm-hmm. So it's a paper price of a paper contract, the vast majority of which aren't ever delivered into, which represents the gold price. Now, to me, the price of gold is completely different. The price of gold is what you have to pay to put an ounce of gold or a bar of gold or a kilo of gold in your hand. Mm-hmm. And that tends to cost you a lot more than the gold price because there's a premium for owning the physical asset. So I don't look at the price of gold. I really pay very little attention to it because I know, I'm very confident over the long term it will do what it's supposed to do. It'll protect my purchasing power, which is what I really care about when I hold my reserves in gold. Mm-hmm. I know that at any point in time I can exchange it, either for currency, either for dollars or Aussie dollars or pound sterling or yen or whatever I want to trade it for, or I can trade out of it and exchange it for an asset that I wish to own more. And that's really the way I think of it. People ask me, when will you sell your gold? And I've said this often, I'll never sell my gold. I'll exchange it at some point for something I want to own more that I think provides more value. So for example, if we had a real estate bust, which it is a distinct possibility at some point, and house prices get cut in half, even if my gold falls in value, it's not going to get cut in half, I doubt very much. So at that point, I may decide to exchange my gold for a home that I couldn't have afforded before the real estate crash, but which I think over the next 20 years will serve me better than my gold will, which is possible. I can maybe earn a rental income from that house or whatever it may be. Mm-hmm. But it's really not a question of the price of gold. It's a question of, okay, are there assets that I would rather own than my gold at this point in time? And if so, I'll exchange them. So once you take out this fixation on the price of gold, once you understand what it's there for, and you understand that the price is certainly, in my opinion, by far not the most important part of what makes up the utility of gold, it becomes much easier to think about it in terms of how many units of my gold would I have to swap for this property or that unit of the S&P. And by thinking of it that way, it certainly helps you sleep better at night, because you don't worry when you read about how gold has fallen through $1,800 or it's knocking on the door of $1,900 and can we get through. It kind of takes all the stress with those events out of the equation, and you just look at it for what it is, which is it's how you're holding your liquid reserves.
Mm-hmm. Okay, thanks for that. I know you don't like putting prices on gold, but every difficult period or crisis, it has been shown in the past that if you made the right decisions at the right time, you could get better out financially. Do you think we can go to the same period with gold or silver as between 1970 and 80?
Yeah, look, I definitely think we can. You know, it's interesting. There's a great chart that I put in one of my presentations many years ago, over a decade ago, and it was a chart of it. It took $100, and you made one decision every 10 years as to where to invest that money. Mm-hmm. And you started off in the 80s with Japanese equities, and you invested in 1980. You put $100 into Japanese equities, and at the end of the 80s, you had to sell those Japanese equities. If you sold, you just left them in there, took all the movements in the markets, just ignored it. And in the beginning of 1990, you put that money that have now compounded over those 10 years into the NASDAQ, and you ran that for another 10 years up till 2000. You took it out of the NASDAQ, and then you put it in gold in 2000. Sorry, I should start. You start in the 70s with gold. I beg your pardon. Start in the 70s with gold, the 80s Japanese equities, the 90s with NASDAQ stocks, and back to gold in the 2000s. And if you look at what those 4 decisions did for your portfolio versus trading in and out, or you know, making the kind of decisions that you make based on the price action in a given month or a given week or a given year, you'll see that just those 4 decisions gave you a 250 times return on that $100. And you know, it began very well in the 70s because of what gold did. Going from $35 to $800 is obviously a huge move. But again, in 2000, if you put that money in 2000, you know, you went from $250 up to, you know, almost $1,000. So I think if we get inflation back, we will absolutely see a similar period in gold. Now remember, the period in the 70s, you had come off it being artificially pegged. It had been pegged at $35 to an ounce because of Bretton Woods, and Nixon removed that peg in 1971. So you definitely got a kicker there when they removed the artificial pressure keeping the gold price lower. It would have been higher than that before 1971. So you definitely, that gave you a stronger run in the 70s than you would otherwise have. But I think the 2000s run is far more realistic to expect, which is, you know, gold rose roughly 4 times during that period, from 250 to 1,000. But from here, we'd be talking, you know, 2,000 to 8,000, and it's those kind of numbers that kind of get people all fired up about, you know, gold going to 8,000. But you know, the problem is you have to be careful what you wish for, because if your gold allocation is going up 4x, there are problems outside in the rest of your portfolio that require some serious attention. So, you know, gold is a signal that something is very wrong. And whilst I think there are plenty of things that are very wrong, and I fully expect gold at some point to reflect that, it's not happening right now, and a lot of people are getting frustrated, which I understand. But again, if you're not worried so much about the price of gold, but you're concerned about what it does for your portfolio, then whether it's 1,800 or 1,900, it really doesn't make any difference when you need it. If we do have massive dislocation elsewhere, gold will do what it's supposed to do. It will protect your purchasing power, and even if the price of gold stays the same and everything else falls, it's done its job. If it goes up as well, simply because there's a scarcity of it, or we start to get some kind of monetary reset, that's just added fuel to the fire.
Okay. I think we had a lot of information. Grant, great to share this information with us. Thank you for coming in our show, and maybe we can put your website in the description where people can subscribe for your newsletter, I understand. That's right?
Yes,
yeah?
Absolutely right. That'd be great. Fantastic.
And
Thank you very much. It's been a real pleasure, John.
And do you have an own YouTube channel or not?
I don't do much. I have some presentations up on YouTube and stuff that I've done in the past about precious metals, but the easiest place to find them actually now is not the YouTube channel, but it's on my website. You'll find them all on there, and it's grant-williams.com. You'll find all my old presentations there, and most of them are about precious metals.
Yeah. Okay, we put them in the description. So I appreciate your time, and we hope to see you again in the future.
Great pleasure, Donnie. Thanks for having me. I appreciate it.
Thank you. Bye bye. Volg ons YouTube-kanaal voor aankomende interviews met meer experten van over heel de wereld. Word ook lid van onze besloten Facebookgroep Silver Squeeze, Goud en Zilver, waarom, wanneer, hoe en waar. Zo blijft u op de hoogte van alle nieuwe updates over de markt. Wilt u meer info of advies over het aankopen van fysiek goud of zilver? Ga dan naar onze website www.europesegoudstandaard.be. Bedankt voor het kijken en tot een volgende video.